Welcome to this explainer. Okay, I want you to picture something for a second. It's a scenario that literally plays out thousands of times a year, whether you're in the US, the UK, Australia, Germany, or Canada. It starts quietly. There are no sirens, no dramatic true crime music playing in the background. Just a standard, official-looking envelope sitting innocently in your mailbox. It looks like totally routine mail, but it actually has the power to turn your financial world completely upside down. So today, we're opening the file on a financial investigation of sorts, an investigation into your own wallet. We are going to look at the hidden triggers, the silent alarms, and the unseen tripwires that alert tax agencies to take a much, much closer look at you. Imagine you've spent weeks meticulously preparing your tax return. You finally hit submit, you breathe this massive sigh of relief, and you just move on with your life, right? The stress is over. But then months pass, and out of nowhere, that official letter arrives. You tear it open, start scanning all that dense, bureaucratic jargon. Instantly, your heart starts racing. Your palms get a little sweaty. That financial peace of mind you thought you had secured, it just evaporates in an instant. And then the questions just flood your mind. You're thinking, wait, did I make a mistake? Did I miss a digit somewhere? Did I forget to attach a form? And then the ultimate, terrifying question hits you, am I being audited? Honestly, it's a universal anxiety. I can tell you from personal experience, the first time I ever got a letter from the tax authority about a discrepancy with a freelance business I was running, my stomach absolutely dropped. You immediately jump to the worst-case scenario, thinking they assume you're some kind of criminal mastermind hiding millions in offshore accounts.
Well, let's dive into this, because the truth is actually kind of surprising. Most audits don't start with some elaborate Hollywood-style tax fraud. They rarely involve secret briefcases of cash or complex shell companies. The stark reality is that there's a huge difference between intentional misconduct and something way more common, honest mistakes. Most of this unwanted scrutiny stems from careless reporting, typing errors, and missing records. Simple, everyday inconsistencies are what actually feed the audit machine, and to protect yourself, we need to look at the specific clues tax agencies are actively hunting for.
So let's open up our first piece of evidence in this investigation. Clue number 1, unmatched income. You have to think of the tax agency's computer system as a massive, hyper-efficient matching game. When the income you report doesn't perfectly align with the records submitted by your employers, your clients, or your bank, an automatic red flag goes up. Boom. This is where people get caught completely by surprise. Imagine you're running a really successful side gig. Maybe you're selling crafts online, doing some graphic design on the weekends, or driving for a rideshare app. You're doing great, but when tax season rolls around, you honestly just forget to log those freelance earnings. Or, maybe you forgot about that small investment account that generated a few $100s in dividends. The company that paid you reported it to the government, but you didn't. And to the tax agency, this doesn't look like a simple memory lapse. It looks exactly like concealed income.
So, forgetting income is incredibly dangerous. But here's the crazy twist in our investigation. While forgotten income is a massive red flag, our next trigger happens when you remember entirely too much. What happens when your memory becomes a little too generous regarding how much money you spent? Stick with me here, because this next trap catches some of the most well-intentioned people out there.
That brings us to clue number 2, dangerous deductions.
Look, we all want to lower our tax bill. That is just smart finance. But unusually large deductions compared to your income act like a flare gun going off in the dark. This is especially perilous for small business owners and freelancers who stumble into what I call mixed-use business blunders. Personal travel, personal vehicles, entertainment, the lines get blurred so easily. I actually remember once sitting there trying to figure out if a lunch with a friend who casually gave me a sliver of career advice somehow counted as a valid business meal. It's so tempting, but claiming personal trips or mixed-use purchases as 100% business expenses is basically a fast track straight to an auditor's desk. And this brilliantly illustrates the core rule for this entire explainer. The key issue isn't claiming deductions, it's being able to support them. Legitimate, massive deductions are perfectly fine if you actually have them. But you absolutely must have the armor to protect yourself. That armor is made of documentation, receipts, logbooks, and meticulously kept records. If you can't prove it on paper, it literally didn't happen in the eyes of the tax agency.
But let's say you are perfectly honest. You have every single receipt neatly filed away. You separated your business and personal expenses flawlessly. You are 100% ready to file. What if the danger isn't in your shoebox of receipts at all? What if your own keyboard is about to completely betray you?
Let's uncover clue number 3, the math mirage.
People are generally terrified of complex tax laws. They stay up late reading about depreciation schedules and capital gains loopholes. But ironically, millions of people fall victim to the absolute simplest element of taxes, basic math. It's frighteningly simple. A typing error leads to wrong account information. A missing number leads to totally incorrect figures. Imagine accidentally adding an extra zero to your income, or leaving a zero off the taxes you already paid, or maybe just transposing a 6 and an 8. These tiny, seemingly harmless slips of the finger snowball into massive discrepancies, and that forces the tax agency to halt your processing, freeze your refund, and send you one of those terrifying letters.
So we've seen how simple digital mistakes can haunt you. But this investigation gets even murkier when the money leaves absolutely no digital trail at all. What happens when there are no credit card statements, no bank transfers, and no digital footprints to follow? Things are about to get really complicated.
We are now looking at our next clue, the invisible money.
Now, let's be super clear about this. Operating a cash business or receiving cash payments is not inherently wrong or illegal. Plumbers, service workers, and market stall owners do it every single day. The problem is that cash is practically invisible. The cash itself isn't the crime. The lack of organization backing it up is what gets you flagged. Large cash-based activity requires exceptional organization, because if an auditor asks to see your records and you hand them a spiral notebook with a few smudged pencil numbers, they are going to heavily scrutinize every single aspect of your financial life. Strict record-keeping isn't just a polite suggestion here, it's your only lifeline.
Okay, we've covered unmatched income, massive deductions, keyboard errors, and the dangers of invisible money. But actually, none of these are the biggest threat. There is one final trap. It's so common, so deceptively simple, and it consistently ensnares thousands of taxpayers right at the finish line every single year. Let's look at the ultimate red flag.
Welcome to the ultimate tax trap, missing time and paper.
This really isn't about malicious intent. It's just about human nature. It's that deadly combination of procrastination and disorganization that basically rolls out the red carpet for an audit. First, we have missing documentation. You buy something and tell yourself, oh, I'll remember what this charge was for. Spoiler alert, 6 months later, you absolutely won't. The thermal ink on the receipt fades away, the paper vanishes, and when the tax agency eventually asks for proof, you have nothing but a blank stare. And then we have repeated late filing. Tax agencies love consistency and predictability. When you repeatedly file late, you are practically waving a giant flag that says, hey, my finances are chaotic and disorganized. Underestimating these strict deadlines destroys the exact consistency that keeps you off their radar in the first place.
All right, the tension of the investigation is over. Now it's time to build your audit defense plan. We've seen all the red flags, and now we are pivoting to empowerment. Here is your 5-step defense plan to protect your personal finances so you never have to fear the mail carrier again. Step 1. Report accurately. Gather every single 1099, W-2, or foreign equivalent and make sure it matches perfectly. Step 2. Keep detailed records. Digitize your receipts right away. Please don't rely on fading paper. Step 3. Separate finances. Never, ever mix business and personal expenses in the same bank account. It is just a recipe for disaster. Step 4. Double-check numbers. Read your return twice, maybe 3 times. Don't let a misplaced euro trigger an audit. And Step 5. File on time. Show the tax agency you are responsible, organized, and reliable. Never guess, always use solid documentation.
So the crucial point to remember today is this. The goal isn't fear, the goal is accuracy. Most tax problems do not begin with some master plan to defraud the government. They begin with everyday carelessness. But as we've seen, a little bit of preparation, a little organization, and double-checking acts as the absolute best form of protection you can have for tomorrow. Accuracy is your shield.
I want to hear from you now. Which tax red flag surprised you the most? Was it the sheer danger of a simple typing error? Or maybe the absolute necessity of keeping personal and business travel completely separate? Let us know down in the comments. And hey, if you found this explainer valuable, make sure you hit subscribe to NexClaim right now. We regularly break down complex topics around taxes, insurance, banking, and wealth building so you can protect your hard-earned money and really grow your financial future. Thanks so much for learning with us today, and we'll see you in the next explainer.